Thank you to everyone for joining us on this Wednesday late afternoon. We appreciate it very much. I know we've got clients joining us, and we have some folks interested in becoming clients joining us, and we have some business partners joining us, and we appreciate all of you, your interest and your time this evening. So thank you. You're, of course, joining us for Summitry's Tax Optimization During Uncertain Times event. And let's jump right in and get into the content. So let's go to the next slide. Go next one forward. Okay, so first and foremost, let me introduce the team that we have here from Summitry this evening. First and foremost, Mandy Pham is one of our senior financial advisors. Mandy is one of the only advisors you'll meet who is a chartered financial analyst, an enrolled agent, and a certified financial planner. So she has a ton of letters after her name, but Mandy has very important designations, and that EA designation is enrolled agent, which is a particularly meaningful one when it comes to tax planning and tax expertise. So we're delighted to have Mandy with us this evening. Fun fact about Mandy, she was actually featured as one of Financial Advisor Magazine's 10 Young Advisors to Watch in 2022. So you will all literally get the pleasure of watching her this afternoon. So delighted to have Mandy with us. We're also joined by David Langhouse, who is also a certified financial planner. David's one of the financial advisors here at Summitry. And fun fact about David competes at a high level in Ultimate Frisbee and has also spent time coaching youth Ultimate Frisbee players. And that is, in all likelihood, something you will not get to watch him do this afternoon. But we do have David with us, and he will be sharing his tax expertise today. So thank you both. I'm Alex Katz. I'm one of the partners here at Summitry, and I have the enjoyable job of simply moderating this afternoon's webinar and to be the one who gets to share the important disclaimers. So let's go to the next slide. And the disclaimer here is that the material we're covering today will be discussed in very general terms, and a very important reminder to anyone that before taking any action on the strategies that we discussed today, we strongly advise you to consult your CPA or tax attorney, and of course, for the Summitry clients on the call, to speak with your Summitry advisor as well. So let's go to the next slide, and we'll talk through the game plan for our webinar today. We have about a half hour worth of prepared content, maybe a little bit longer, and then we're going to save a whole bunch of time for Q&A. We've done similar events to this in the past, and we almost always get a bunch of questions coming through. So this is my time to remind you that there is a Q&A tab at the bottom of your screen, and if you have any questions, please just submit them there, and we will get to as many as we possibly can at the end of today's talk. So we're going to start the conversation today looking at 2023 year-end year income tax planning opportunities. So that's very much about the remaining month and a half in the year and what we can still do for optimization. Then we're going to shift gears and talk about the phase out of both the income tax and the estate tax provisions under the 2017 Tax Cuts and Jobs Act. So there's phase outs coming at the end of 2025. So we have a couple of years to take some action in advance of those phase outs. So those will be the key considerations that we share for 2024 and 2025 as they relate to those phase outs. We'll try to bring these to life in the form of a couple of case studies, some stories, and of course, we hope that this inspires lots of questions and lots of conversation. So again, reminder, submit questions through the Q&A tab, and with that, I will turn it over to Mandy.
Thank you, Alex. Next, please, Anne. Yeah, so I just want to start with, before embarking to any type of planning, and particularly important for tax planning, it is critical that we reflect back and have a good understanding of what is your current situation for the years. Most clients tend to focus the tax planning conversation during the year that they have a lot of income. So maybe you have a big raise, a big promotion this year. maybe your company stock did really well and you have a lot of ISU income coming in for the years, or you sell some appreciated asset. But on the flip side, it's also very important to thinking about planning, optimizing during the year that you may have not a whole lot of taxes. Maybe you take a break in your career, maybe you take a sabbatical, or maybe you just decide to retire this year. So it's important to also optimize for these years, and we would cover both phases. So the first part of the presentation for the 2023 planning, we're going to focus on what if your income is higher this year. And next, please. So this is probably not the first time you hear me or anyone talk about this, but at the top of the list is always very important to making sure that you maximize all the annual tax advantage account contributions. So your 401k, your 403b, your IRA, if you are a business owner, maybe you have the opportunity to contribute to a solo 401k at a higher limit. Maybe you can do a SEP IRA, maybe you even open a pension. So if this year is going to be a year that you have relatively high income and maybe you at the highest tax bracket, then it's important if you can to maximize the contribution to these tax deferred account, because it's a dollar for a dollar in terms of reduction in income. Is the fund, the balance inside this account also grow tax deferred until much later on in your life. Now, I am also a very big fan of the health saving account. If your medical plan allow for it, if you are currently enrolled in a high deductible plan, because this is the only account that allow you to have triple tax benefit, and our client tend to have more medical expenses later in life, and we all universally going to pay for Medicare premium and medical premium in the future. So these distribution can be taken out at that point, tax-free. When contribution, you also receive tax deductions. The fund grow tax-free, and it will be tax-free distribution in the future. So in my mind, it's actually better than a Roth IRA, and you do not face the income tax threshold. You can contribute as long as you qualify, your medical plan qualify. Next, please, Anne. Equally, also a dollar for a dollar in terms of tax saving is, and I start seeing this become more and more popular with tax company in the Bay Area, and also the company that offer a deferred compensation plan. It used to be only at the director level, but now I start seeing the company offer to a lower employee level. So Apple, Adobe, Intuit is an example of the few companies that have a deferred compensation structure in place. And it's usually allow you to defer a very substantial part of your salary and up to 90% of your bonuses. So to the extent that saving taxes in the current years is a goal, then it can have a very big impact. Now, it's not quite good as a tax advantage account, because you likely, the company likely require you to take distribution as separation of service, not until you 73, like an IRA or 401k. So it's important if you are eligible for a deferred compensation plan to talk to your advisor to make sure that this can be adopted as part of your saving plan and not overdo the deferred compensation plan. Because I also see retiree client on the other end with a couple million in a deferred comp plan, and now also get taxed at the highest bracket. So it's defeat the purpose in a way. Next, please. So
thanks for covering some of the ordinary income items there, Mandy. And we want to also talk about some of the strategies for some of the other types of income, like your capital gains for the current year. One strategy to be able to kind of control the income tax liability is tax loss harvesting, which would be realizing capital losses before the end of the year, especially since a lot of times when clients have capital gains and taxable accounts, they don't necessarily allocate for the additional capital gains tax that will become due in April. And if you are Medicare eligible, some of those realized capital gains may impact the Medicare surcharges that you're responsible for throughout the year. You want to make sure that you avoid any wash sale rules, which would disallow you to take those losses for recently purchased or sold securities, as well as making sure that your overall asset allocation isn't impacted too drastically by those changes, especially during volatile market periods. When you have to be out of a position for at least 30 days, there can be pretty drastic swings. You'd want to make sure that you are also considering the type of investments in your taxable brokerage accounts, due to the fact that your mutual funds or ETFs may have capital gains distributions very late in the year, sometimes as late as the last week in December. So even if you had thought you had everything tucked away and planned for those unexpected distributions, and since you're not in control of those distributions, you may have a liability that you weren't prepared for. Summitry, we tend to utilize the individual securities within our portfolios for one of the main reasons being that we have more control over when to realize those gains and losses over time. Next slide, please. You can also work toward accelerating your deductions, especially over these next couple of years where we have a very high standard deduction, which will be going down if there is no tax legislation that we'll cover later. But it's important to consider kind of a multi-year front when it comes to charitable giving. And you do have the ability to bunch together multiple years of those charitable gifts into a single tax year to get a larger deduction if you are in a high income year due to an RSU or a bonus that puts you in a higher category. You can utilize a donor advised fund to bunch those contributions into that single year. And if you are in your RMD eligible years, you can have a dollar for dollar reduction of your income, which is typically more valuable than a deduction, by making a qualified charitable distribution directly from your IRA account to the charities of your choice. Next slide. During years that you are in a lower income than you may have been previously, whether that's because you decided that to take some time off in between jobs, whether have already retired and you haven't hit that age 73 required minimum distribution date, or just taking a break in your career, there are opportunities to accelerate your realized income at lower tax brackets. For example, up to $89,250 of long-term capital gains can be realized at 0% if you're married filing jointly, or consider accelerating some of your tax-deferred income through Roth conversions. You always want to be mindful of what your individual circumstances will allow for in each of these brackets. Certainly want to check with both your tax professional and your financial advisor when considering any of these strategies, and keeping in mind that you may be pushing, by accelerating income, pushing yourself into other, whether it's Medicare IRMAA zones or increased amount of Social Security benefits that become taxable.
David, I do want to jump in here real quick, just because this is a conversation that I have with 3 clients within the last month. Is if you happen to purchase an electric vehicle that you qualify for the 7,500 credit, and we start seeing like vehicle become available and a lot of clients start purchasing them, is if you do not have tax liability this year, then this credit is non-refundable. It's not carry over in the future years. So you will need to have at least 7,500 tax liability, not taxable income, in order to completely maximize this credit. I literally have a conversation with a client this morning. They're going to pick up their car this afternoon, and we're talking about 50,000 Roth conversions so that we can create this income, because the client they retire. They have taken money out their trust account to live on. They have 40,000 gain this year that going to be taxed at 0%. So literally, when we run the tax projection, the client have 0 tax liability for the years. and knowing that they have 7,500 credit, that use it or lose it, we were able to do a 50,000 Roth conversions, and they're going to have a 50,000 tax-free growth for the next 30, 40 years. So I just want to do a quick plug here, because I do know that a lot of our clients purchasing electric vehicle because of the credit, and you don't want to lose the credit just because you don't have a taxable income. Okay, I'm done, Alex.
That's a great insight, Mandy. I love that one. I love the idea of having to plan to create a tax liability with your clients. So
yeah, that's definitely unique.
That's a great nuance. I love it. These are exactly the kinds of things that we're here to discuss. Perfect. So thank you both. So part of my job as moderator here is to move us from chapter to chapter. So this sort of concludes chapter 1, which is the 2023 tax optimization opportunities. And now we move into the forward-looking, the expiration of the sunsetting of the 2017 Tax Cuts and Jobs Act that is set to expire at the end of 2025, and thinking through some of the implications of that. So the second chapter, what we're going into now, is the income tax implications there. So I will turn it back to Mandy, and why don't we move to the next slide?
Yes, it's already so it's coming up to 2025, and I love that the government, the IRS, Congress doesn't make our job any easier. So I still remember vividly in 2017 when the Tax Cut and Job Act passed. This is because they don't have the budget to pass many of the provisions for at the individual, and so there's 2 sections that were passed in 2017. I just give you a little bit of history. So corporation tax were cut from 35% to 21%, and that they were able to make permanent. But many of the provisions that apply to individual tax filer, families, small businesses that not corporations, were set to sunset at the end of 2025, meaning whatever changes that happened starting in 2018, it were meant to be temporary, with the hope that between 2018 and 2025, someone can make it permanent. And we're getting very close to 2025, and there may or may not be any changes within the next couple of years. So everything all becoming new again. So we get to relearn what we know before, and it can be very confusing. I still remember one of the big things that clients freaked out at the time of this law passed were the limitation of state and local tax deductions. I mean, I was in Houston at the time. Some of my clients have 60,000 property tax that no longer be able to deduct. And I imagine for clients in California, that would be 60 to 80,000 of state and local income tax that you are not be able to deduct. And now we get to deduct it again. So a few of the provisions that coming back, and next please, that we want to highlight is with the impact, so the Tax Cut and Job Act were able to reduce in terms of marginal bracket a few percentage across all income level. So now when it's sunset, meaning the marginal tax bracket that you were paying tax on the same income going to be higher, and we will show you in a little bit some more than others. There will be eliminations of the 10,000 sole deduction cap, state and local tax deduction cap. So if you your California state income tax will be fully itemized again, your property tax will be itemized again. So that would put a lot of our clients coming back to the itemized deduction as opposed to taking standard deduction. The other part of it is the standard deduction were double as part of the tax changes in 2017, 2018. It will revert back to the lower level. So it for a married couple, you deduction this year would be close to 29,000, and it will be cut by half when this new law, well, I guess it's not new law, but it's the new law gets sunset. And then the other thing, which is also important, and I almost don't have to talk about alternative minimum tax for the last several years, because one is the we don't have a whole lot of deduction to talk about anymore. And then there is a huge AMT exemption that will put in play in as part of the Tax Cut and Jobs Act, and now that going away. So alternative minimum tax going to be relevant again to many of our particularly tax employee who have very high income. Next, please. So David, going to, yeah.
Awesome. Yeah, thanks, Mandy, for going into detail on some of those changes. And as Mandy mentioned, the specific tax brackets are going to shift with the sunset starting in tax year 2026. And the biggest changes are going to be particularly felt in the middle brackets and on the higher end. As you can see here, we have the 2023 rates in the second column and the projected tax rates for where they will end up in the third column, highlighting the differences for the amounts of taxable income for clients that find themselves in the middle brackets as well as the high end brackets. Next slide, please.
So let's go through a couple case study, and this is very close to real client scenario that we're working with, because you can see with the changes, some is favorable, some is not. So obviously marginal tax bracket is higher, but then you get to itemize a lot more of your state and local tax. So it's probably in your mind, like, how is it impact me? Let's go through this is one of our example of clients, Dave and Kate. They both work in tax and with significant RSU vesting every year, combined earned income of about $1 million, meaning they probably pay about $80,000 in California income tax. They have a house, $3 million house in Los Altos. They're paying about $35,000 in property tax. And they have a mortgage for $1 million at the rate of 5%. So they have a $50,000 mortgage interest deductions. As you can see in here, with the sunset, meaning if there is no changes. When we say with the sunset, meaning there is no major tax reform that happened in 2023, 2024, and 2025. And the old law coming back again. So post sunset, Dave and Kate will be able to itemize their deductions. But then, well, one of the things that I didn't mention in the slide before, I don't know if you remember, but there is what called Senator Pierce limitation on itemized deductions. So for if you have income of over 400,000, any additional dollar of your income will reduce your itemized deduction by 3 cents. So for all intended purposes, it's a reduction on itemized deduction, but it's also like a surtax in a way. So they will face some limitation on the itemized deduction. So the total amount that they can itemize is 146,000 and change, compared to based on the current law, meaning if there is no sunset, they can only itemize the 60,000 in market interest, and then 10,000 of the state and local income property tax and state income tax, only 60,000 in itemized deduction, and drastic change. So bottom line, their total taxes that increase a little bit, but if as a percentage, you're looking at about 1.5% increase, so not huge. It is a few more thousand, but it's not a significant increase. Now, the tricky part here is AUC, because of the very big itemized deduction that will be added back under the alternative minimum tax system. They will be paying alternative minimum tax, and that alternative minimum tax is a parallel tax system that there's only 2 tax brackets, 26% and 28%. So their marginal tax bracket will be 28%, not 37. And that's have a lot of planning implications. Any charitable deduction that they're going to make, once $1 of deduction would only reduce their tax liability by 28%, not 37%. Or if they might want to consider in the future, they might want to consider a Roth IRA, well, not a Roth IRA, Roth 401k contributions, because again, so we reduce their taxes by 28%, not 37% like today, before the sunset. And go to the next slide, please. So a few considerations for Dave and Kate would be, to the extent that they can, and if it part of their plan is to defer taxes in the next couple of years through a tax advantage account like a 401k account, or if a deferred comp is something that they want to have or it fit into their financial plan, then it's more beneficial for them to make the DCP contributions within the next few years compared to in the future year, again, assuming similar fact pattern, and they will be facing an AMT situations. A lot of our clients thinking about making a big donation into, like, let's say, a donor advised fund with highly appreciated stock, or doing a charitable remainder trust when they get significant charitable deduction in the year of. It will be a lot more beneficial for them when their marginal tax bracket is 37%, like this year or the next couple of years, compared to when their marginal tax bracket is at 28%. Again, assuming they have similar patterns like Dave and Kate. Another reason beyond the itemized deduction situations, another reason why people face alternative minimum tax is when they exercise incentive stock option. So even if your option is not expiring this year, it's worth having a look. And actually, I think for a lot of clients, it's very beneficial for them to exercise a portion in this year and the next few years up to the amount that they get to AMT, because at the current time, they can exercise quite a bit and don't pay any additional taxes and take advantage of the tax incentive for the ISO. Again, this strategy is quite complicated, and it's important to project out, and it's important to talk to your tax advisor or your financial advisors before you implement everything. I just want to bring this topic as top of mind so that you know what to ask. Next, please, Anne.
Thank you, Mandy. We want to cover another potential client situation where we're talking about Bob and Susan Hamilton, and they are more on the retiree side, where their taxable income is about $230,000 with distributions from their IRAs, as well as pension, Social Security income, and a little bit lower deduction limit, partially because they pay a much lower property tax since they've been able to maintain that lower property tax for a longer period of time. One thing to note here specifically is the standard versus itemized deductions in these scenarios, where currently, as we mentioned, the standard deduction remains particularly high and will be cut in half with the sunset. Thus, Bob and Susan would be itemizing their deductions in a post-sunset scenario. Their tax liability in the same scenario would increase by almost 14% and move them to a higher marginal rate. In reality, Bob and Susan actually both experience higher marginal rates and lower deductions with this change. So they pay higher tax rates and overall higher tax liabilities for that same level of income. Next slide, please. Things that Bob and Susan can consider before the sunset at the end of 2025 is to accelerate their income to fill up on those lower marginal brackets. So being able to pay tax on income at 22% versus the potential for 28% is already a 6% savings right there. You can do this by converting IRA dollars to Roth to hopefully also reduce future required minimum distributions, or realizing other forms of income that may be available if there has been a deferred annuity potentially, or accelerating some of those capital gains into the current year. Unlike our Dave and Kate, considering delaying their charitable contributions into the post-sunset world due to the higher marginal rates to get a better dollar for dollar deduction for those same contributions over time. And as you can see, there's each of these pieces of the current tax law and future potential tax law can be quite the puzzle. So working with someone like your financial advisor to kind of fit all of the pieces together in the design of your goals is really important to make sure that we're making the right decisions and considering those long-term planning approaches in addition to just the current years.
Yeah, I just realized, and this is totally not planned, is we have a client, a family with $1 million in income, and we have a family with 250,000 in income, and they happen to be in the same marginal tax bracket, which kind of crazy, but it's real.
Thank you. Thank you, Bob. Yeah.
Yeah, that's why we really want to consider these multi-year planning strategies across the board and not necessarily just think about what is the best way to reduce your tax liability this year.
Yeah,
absolutely. I think that's a very important perspective, and hopefully these two case studies, these stories of clients in different phases of life, brought some of these strategies to life in a little bit more of a tangible way. I know the stories definitely helped me kind of follow how the strategies play out. So thanks for bringing those two to life. All right, let's move on to the next slide, and we're moving into our final chapter here. So we're staying in Tax Cuts and Jobs Act sunsetting at the end of 2025. But now we're moving out of income tax and we're moving into the estate tax implications. So with that, why don't we go to the next slide? And David, I'll turn it back to you.
Awesome. Thank you, Alex. With the estate tax exemptions, both looking backward and forward, it's consistently been a political football that gets punted around the field. An apt description for this time of year. But when we're making considerations for our future plans, keeping in mind that with the current exemption at nearly $13 million set to sunset in at the end of 2025 and reducing again by about 50% to just about $7 million per person in 2026, this is going to be it's going to be something that will impact Bay Area families more so than some others across the country. A lot of that has to do with the property values and the overall estates that you may have access to with being if you've been employed by a tech company that has been done particularly well, and it will shape kind of the transfer of wealth across generations. Next slide, please. And as Mandy mentioned, these are the types of provisions that if you don't use them, you lose them. So you kind of get one chance and one opportunity to take advantage of these all-time high levels for the estate tax exemptions. Outside of the overall estate tax exemption, you also have annual gift exclusions and in addition to your lifetime exemption. For example, if you're in a situation where you think that you may be subject to the lifetime, utilizing the entirety of your lifetime exemption, annual gifting during your lifetime may be a wonderful strategy to start that transfer process during your life, and you have the ability to give up to $17,000 a year, gift tax-free in 2023, set to increase next year to $18,000. And for married couples, you can double that amount since each gift can be given individually per person per beneficiary, and you can give to as many recipients as you'd like. With the federal gifting exemption in 2023 set to about almost 26 million for a married couple, having that drastically decreased in 2026 could impact a lot of planning and in overall have increased the tax liability for your heirs. Next slide, please.
Anne. Yeah, so before, as David mentioned, this is particularly, let's start with the annual exclusion first. It's either use it or lose it. So if gifting, lifetime gifting is part of your strategy to shift asset to the next generations, it's before the end of the year, you can give cash or stock outright or through trust or for a minor to an ATMA account. You can also, one of the things that some of my clients consider is if you have highly appreciated asset and you have either your children's or your grandchildren's, they're at the very beginning of their career, they might be in a lower tax bracket, is to give them the stock itself and allow them to sell and pay the tax at a lower bracket. And to the extent that they don't have a whole lot of income and they're not a minor, they might be able to pay long-term capital gain at 0%. So it can be not only estate tax planning strategy, it can also be an income tax strategy for the whole family. So keep in mind, it's not just cash, it can be stock too, and we can help you facilitate the transaction fairly easily. The 529 is another strategy that you can use, and you can actually elect to use 5 year worth of annual exclusion to two-ball fund a 529. And it can be a legacy, educational legacy for the family, because the beneficiary of the 529 can be changed between sibling or linear bloodline. Also keep in mind that if you have any family member paying medical or educational expense, is to pay it directly to the provider, so it's not count toward the annual exclusion or your lifetime exclusions. Next, please, Anne. So with the temporarily very high estate exemptions, the IRS have come out to say that if you do use up all of your exemptions, so if you make a $13 million gift today or before the provision sunset, that there would not be a clawback of taxes when the exemption go down. However, in order to utilize the higher exemption, you do have to give more than the lower limit when it's sunset too. So you have to give more than 6.5 or 7 million in order to take advantage of any of the high lifetime exemption. Because otherwise, if let's say if you give 7 million, you use up 7 million of your lifetime exemptions, and it fall back to 7 million, then you would have used up all of your lifetime exemption after sunset. We understand that not all clients can afford to make this kind of gift to you, the exemptions. So there's some strategy that have been flowing around for the last few years, like a spousal limited access trust have been a popular tool. But now we start seeing problem with it, like divorce. What if I make a trust for my spouse and we get divorced? And so it's important, if you do want to make this intergeneration gift, and it's a very large amount, to talk to your advisor to make sure that you retain enough asset to maintain your lifestyle or do everything that you need to do. And also you don't do anything irrevocable and losing control just so that you use up the exemption. If you can afford to give, let's say you have over 20 million and you single and only have one exemptions, or if you have, like, let's say more 30, 40, 50 million, then definitely this is something you should consider, because again, estate tax is a 40% flat for anything above the exemption. So it can be $1 million of tax saving. And next, please, Anne. And this is my plug for, regardless of the amount in your estate, regardless of there is any tax law changes, it's important to make sure that your estate plan is optimized. It's not a set it and forget it plan. Review to make sure that you have all of the documents in place. We make sure that the people that you name is still the best people to serve for their role, executor, trustee, power of attorney, and that your asset is actually titled the way you want it titled and the beneficiary designation is correct. Because having a plan without the titling correctly and the beneficiary designation correctly, then it can be for nothing. So again, don't set it and forget it. Make sure that the plan that you have is still the right plan, and this is a perfect time to do so.
Perfect. Thank you both. Okay, so lots of implications in the sunsetting in 2025, both on the income tax side and on the estate tax side. And time to make some moves and strategies to implement, but all, as you both aptly pointed out, have lots of multivariable implications. So always important to speak to your advisor and speak to your CPA before making any of these changes. Perfect. Why don't we shift gears? Let's go to the next slide, which I think just says Q&A. So there you go, Q&A. So we can take that slide down and make the faces a little bit bigger here. We've gotten only a few questions. I'm surprised. So if you're bashful and you're sitting on a question or two, by all means, hit the Q&A button at the bottom and feel free to submit them through. But we'll work through the questions that we have so far. So Mandy, why don't we go to you for this first one? So the question is, I'm getting close to retirement and my 401k plan custodian mentioned the option of a qualified deferred annuity to defer my required minimum distributions. Is this something I should consider?
Yes, so I got quite a few questions from clients because like they receive communication from Fidelity, Swap, or their 403b. Like one of my clients with the state of California, they also push this information. So what it is it's allow you to use a portion of your 401k 403b to purchase an annuity contract that defer payment, meaning the payment would not start paying out most likely at age 85. So the payment is very high, but there's might be a good chance that you never get any payment, or you only get payment for a couple of years. And the concept of a deferred annuity is not new. It has been around for a long time, and it can be a very effective tool if you want to maximize your current spending, but also want an insurance for if you live for a very long time. That you want to make sure that you have some minimum amount. Like client might want to say, I want to maximize my spending for the next 20 years. I might not live past 85, but I want to have an insurance policy. And that would be a good strategy for these type of client who are going to spend most of their asset, if not all of their asset. Like any longevity hash, if you never make it to 85, or if you only live to age 90, you only get a few years of payment, and there would be nothing to your spouse, to your heir. So it can be effective if running out money is a real concern. Two is if you truly want to maximize spending in the current year with what you have. So it can be a good strategy. It's not for everyone, I would say, and not just because of you shouldn't do it just because you can defer requirement distribution for a few years. It have to be a part of a bigger plan.
Thank you. Okay, great. And we got a couple of questions coming through. So thanks to those of you who are submitting. Appreciate it. Let's keep moving through them. So what kinds of transactions, Mandy, why don't we you hit this one too. What kinds of transactions or activities will make someone subject to AMT?
Yeah, so this is the $1 million questions, and there's a long list, but I would say the two that I mentioned is the most, I would say apply, well, and another one apply to 95 or 99% of the people who paying AMT. So one, state and local tax is added back. State and local tax deduction is added back under the AMT system. So there would be no state and local tax deductions on the AMT system. That's why currently, because there is a huge limitation on how much you can deduct on state and local tax, and that's part of the reason why we don't have to talk about AMT since 2018. The other, and I think this is a big deal for Bay Area clients, is incentive stock option that many clients who work for a private company have. So incentive stock option, when you exercise the ISO, you don't have to pay any tax under the regular system, but you pay full tax on the AMT system. So that is another add back into income. So when client exercise incentive stock option, there is a certain amount depending on their income that they can exercise without, until they get to the point it becomes too much and they pay AMT, and we have to talk about that. The next thing I also think is popular is qualified small business stock. Depending on the year that the client filed the company is taxable under alternative minimum tax, but it's not taxable under or tax less under the regular tax system. So that would be the three top things that I can think of, with the state and local tax deduction is probably the biggest thing.
Perfect. Thank you. Okay, great. So this next question is kind of combining two types of accounts, and I think the question's asking how the two might interplay with one another, and I'll kind of leave this as a toss-up for the two of you, whoever wants to take it. So my granddaughters have 529 accounts, college saving accounts. Can distributions from my IRA distribution be made prior to taking the distribution as income?
So I think the question that were asked were if you can give from your IRA to a 529 without it being taxed. Because absolutely, if you just take your regular IRA distribution, you pay tax on it, you can give to your granddaughter or for any purposes. Unfortunately, this is not one of the exceptions for IRA. Like the only thing you can take out from IRA without being taxed is to give to charity, assuming you 70 and a half. And I think the person who asked the question might be confused with a new development in the tax landscape is if you have a 529 that have been around for 15 years. Like if your granddaughter have a 529 that was set up 15 years ago, and we know that we don't need that for college education, there's a one-time rollover into a Roth IRA. But again, this is not something we can plan ahead, because if you know this is going to happen 15 years ago, then you probably make a lot more good bet than just this.
And contributions to 529 plans do have to be in cash. So there's also no way to avoid capital gains if you wanted to gift the stock to any appreciated stock to grandkids for education, that you would have to have a contribution made in cash as well.
Great points. Thank you. So to the submitter of that question, let us know if we got to your question, or feel free to submit another one if there's a point of clarification you're looking for. The remaining question that we have, I've saved until last because it's the most fun. And this one's going to David because he has the best crystal ball. So the question is, what happens if there's a presidential change ahead of the 2025 sunset? And what's the likelihood, a different way of saying that is, what's the likelihood that we would see the sunset change in some way? So David, how's the crystal ball?
I've been looking into it. Still a bit cloudy. I think that might just be the atmospheric river, but it is something that everybody wants to consider and prognosticate about. Obviously, within our two-party system that we have here in the United States, a lot of times you have the consideration that one of them tends to be more fiscally conservative, one of them tends to be more liberal. However, in the history of U.S. tax law, there has been 9 or 10 really significant changes since the Civil War, and a lot of those have been due to whether war funding or to address adverse economic scenarios, like after the Great Depression or after in 2001 as well. So it doesn't. We don't know what's going to happen, unfortunately. But what we can do is plan for the rules as they exist now, and we can do our best to be as proactive as possible. Whoever ends up in the White House and whoever ends up in control of Congress, each of those factors are going to be very influential on whether or not we see some change and actually see an agreed upon bill that then gets passed. And even over the last few years, we've seen potential tax law be passed or go through one portion of Congress, only to have incredibly large revisions before they pass the second portion of Congress. And Sometimes those considerations can be retroactive to the beginning of the year that they're passed. Sometimes they are not implemented until the future. So while we would love to be able to say, yes, with the sunset of the tax law, we know exactly what's going to happen, our best laid plans can always be amended. And that's why we really take the approach and financial planning approach of an iterative process with our clients here at Summitry to make sure that as both the landscape changes and as your lives change, then we can make those adjustments as we go.
Yeah, and
Perfect.
I would like to add that, like, when we advise client, anything that you do have to fit within your financial plan, that you're going to do it anyway. And whether it's more we do it early or we do it a couple years later. So more like changes on the margins. And the same with investing. Like we always say, you don't choose an investment just because of the taxes. It have to fit into your investment plan as well. So like anything, make sure that we do your financial plan and make sure that this is something that is part of your plan anyways, and we only change it in the margins so that if there will be some, whether big tax reform or small tax change, there will be, and you don't make an irrevocable decision that just because you try to do tax planning. Tax planning is the optimization part. It's not the main goal of everything.
That's perfect. Yeah, I think that's a great closing point. I am a little disappointed that neither of you answered who's going to actually win the election in 2024, but we'll come back to that when the atmospheric river passes and the clouds disappear from David's crystal ball. But I do think that's a great point to close on, which is to say, we may have actually just gotten another question come in. Oh yeah, why don't we'll hit I'll make the point and then we'll hit this additional question that just came in. The point is, so much of the work that we do with our clients is iterative and ongoing. Just as there is no such thing as a financial plan that you set once and then it is your financial plan for the rest of your life, there is no such thing as a tax strategy that you set today and it is your tax strategy for the rest of your life. So this is the ongoing work that we do with our clients. Last question, no crystal ball required for this one, sadly. Can Roth conversions satisfy RMD requirements? See that one as a toss-up to whoever wants to take it.
Well, unfortunately, no. And the best time to do Roth conversion, well, it's tend to be before you have to take required minimum distribution. It just happened to be for many clients. But we also say that IRA is, if you're going to have some inheritance for your children, it's also important to consider that your children tax bracket, because IRA or any pre-tax account will not get a step up in cost basis. So even if you take required minimum distribution and you still have room in the lower marginal tax bracket, particularly if your children are very successful and high income earner on their own. So it might still worth considering. It's not one or the other, but unfortunately, no. The Roth conversion would be on top of what you have to take out for required minimum distribution.
Yeah, and on that front, sometimes when we're working with clients in that vein, making those Roth conversions is an estate planning technique, as Mandy was mentioning, and utilizing the required minimum distribution, paying the tax, but then funding the additional liability that would be resulted from a Roth conversion with that required minimum distribution can be a strategy that you can use throughout the year. So that way a bulk and majority of those Roth conversion funds do end up in that after-tax account as well, growing tax-free and set aside.
Perfect. Excellent. Well, it is before 5 o'clock. We've answered all the questions that have come in. So thanks to everyone who submitted one. Big thank you to Mandy and David for all of the preparation work that went into this evening's webinar and for leading us through it. Thank you both very much. And a big thank you to everyone who joined us this evening. For those of you who are clients, if you have follow-up questions, by all means, the first call should be to your financial advisor. For those of you who are not clients and have questions, you can go onto summitry.com and submit a request, and we are happy to get you to the right person to answer your questions. But thanks to everyone for spending this time with us this afternoon, this evening. I guess I can call it this evening now. And we'll look forward to talking to you all soon. Have a great night.